Welcome back to the deep dive. If you've ever sat across the table from a financial advisor, maybe discussing a pension or an investment, you've probably asked yourself that quiet question. Is this recommendation really the best option for me? Or, well, is it the best option for them? That tension, that kind of friction between the client's interest and the advisor's interest, that's really the heart of our deep dive today. Conflicts of interest in financial advice. At its most basic, a conflict pops up when an advisor's personal financial gain, or maybe the firm's commercial goals, could interfere with their primary duty. And that duty, under regulation, is to act solely in your best interest.
Yeah, and what's often overlooked, I think, and what our sources really bring out is that conflicts aren't always these, malicious plots cooked up somewhere. They are often just a natural consequence of working in any commercial system. It makes sense, right? You've got the client, the individual advisor, the big financial firm. They all inherently have slightly different objectives. The firm wants profit, the advisor wants to get paid, and you, the client, you just want good value and suitable advice. So the critical issue for regulators like the FCA isn't really stopping those differing interests from existing altogether. That's probably impossible. It's making sure those interests don't actually compromise or even appear to compromise the ability to give genuinely impartial, suitable advice.
Okay, that sets up our mission perfectly then. We need to unpack the two main categories of conflicts that firms need to get a handle on, and then walk through the really crucial regulatory guardrails that the system relies on, mostly from the UK's Financial Conduct Authority, the FCA, to make sure integrity wins out. Right, let's start with that foundational split you mentioned, personal conflicts versus corporate conflicts. Maybe we can look at the individual advisor first.
Sure. Personal conflicts are maybe the easiest to grasp because they center entirely on the advisor's own judgment and potential gain. This is where their personal financial interests, or maybe even personal relationships, clash directly with their professional duty to you.
And when you look at the source material, the example that comes up again and again is direct pay, right? Remuneration. Think about it. An advisor is choosing between product A and product B. Now, product A pays the firm, and therefore the advisor gets a slight, maybe a significantly higher commission or bonus than product B. Even if product B is objectively cheaper or maybe a better fit for your specific risk profile, that temptation to choose product A, the one that helps pay the advisor's bills, well, that's a powerful personal financial conflict right there.
Exactly. And it's often not even like a conscious decision to mislead the client. It can be subconscious bias. Studies show advisors sometimes naturally lean towards what benefits them. They might even rationalize it, thinking the higher commission product must be better somehow, maybe in a way they can't quite pin down. And the sources also stress it's not just about money. What if there's a close personal relationship? Say, the advisor's spouse works for a particular fund provider. That could also unintentionally sway recommendations. And importantly, the appearance of bias can be just as damaging to trust as actual bias.
That's a really interesting point, that it's often the structure of the payment, not necessarily the bad intent of the person, that creates the conflict. Okay, now let's scale up. Let's pivot to the bigger picture. Corporate conflicts. These seem like they could have an even wider impact, involving the whole organization.
They definitely can. Corporate conflicts are about the firm's overall business interests getting in the way of its duty to clients. So we're moving from the individual advisor's potential commission to how the entire firm makes its money. The scale is, it's potentially huge.
And the classic example here, I suppose, is what they call vertical integration. Like, imagine a big bank. It has its own wealth management arm, right? And maybe its own in-house fund management division, too. Now, if that bank tends to recommend its own internally managed funds over similar ones from outside competitors, even if those external funds might perform better or be cheaper, simply to keep the management fees inside the group, that sounds like a massive corporate conflict.
That's textbook, yes. The firm's priority in that scenario might lean towards profit retention, maximizing its own internal revenue streams, rather than necessarily doing that truly independent whole-of-market search that, frankly, the client expects and deserves. Managing these corporate conflicts needs really strong governance at the top, because the firm is essentially, sometimes, fighting against its own commercial interests to put the client first.
It's tough.
So, if the firm's own structure can be the source of the problem, who's making sure they behave? Who holds them accountable? This leads us right into that regulatory safety net you mentioned earlier. This is where the FCA really comes in. They mandate very clearly that firms have to diligently identify, manage, and crucially, eliminate conflicts wherever possible.
Yeah.
And this isn't just, a guideline. It's baked into fundamental rules. We're talking about key parts of the FCA handbook, like the Systems and Control Source Book, that's SYSC, and also the Senior Managers and Certification Regime, SMNCR, which is vital because it assigns personal accountability to senior people. The very first step, the absolute critical one, is identification, recognizing the potential conflict. If a firm or an individual advisor doesn't even see that a conflict might exist, maybe it's hidden in the way they get paid, or the products they tend to push, or the referral arrangements, well, then they can't possibly manage it, can they? It needs constant awareness, training, really embedding it in the culture.
Okay, talking about awareness and managing it, let's talk proof, documentation. If I'm running a financial advice firm, what's the one key piece of evidence the regulator, like the FCA, is going to demand to see to prove I'm actually taking conflict seriously?
That would absolutely be the conflicts of interest register. And this register, it needs to be much more than just a simple tick box exercise. Firms have to properly document every potential and actual conflict they identify. And just as importantly, they need to detail the specific concrete steps they're taking to mitigate or control each one. If the FCA comes knocking for an audit, that register is gold dust. It shows whether the firm is genuinely proactive about risk or just, well, going through the motions.
But realistically, doesn't that register sometimes risk becoming just a static document, something the compliance team updates once a year? Especially when conflicts are so sort of woven into the fabric of the business. Can you really avoid them all? Or is it always about managing and controlling them?
That's a fair challenge. Avoidance is definitely the gold standard. It's the ideal. The sources give examples, like completely removing commission-based incentives, shifting entirely to a flat fee for advice model, for instance. That directly avoids that personal remuneration conflict we talked about. Another way to avoid is using genuinely independent product research tools. So the advisor literally cannot see the internal profit margin or commission level when they're making recommendations. Takes it off the table. But you're right, avoidance isn't always practical. Sometimes a firm has to offer its own products, for example. And that's precisely when mitigation and having really robust controls become absolutely essential.
So what do these robust controls actually look like day to day in the firm? How does the regulator get comfort that, one part of the business isn't improperly influencing another?
Well, they rely heavily on operational fixes. The main one is probably segregation of duties, making sure the person recommending the product is functionally, maybe even physically, separate from the team that directly profits from selling it. We also rely a lot on independent oversight. So a firm's compliance team or maybe internal audit needs to actively review transactions, check suitability, ensure client interest really was put first, not the firm's profit. Let's make this even more concrete with a few more real-world examples from the sources. Beyond the in-house product issue, another really common conflict area involves external relationships, specifically referral fees.
The kickbacks, yes.
Precisely. An advisor might get a payment for sending a client to a specific solicitor for estate planning, or maybe an accountant for tax advice. The potential conflict is clear. The advisor might be motivated by that fee, not necessarily by whether that particular lawyer or accountant is truly the best or most cost-effective for your specific situation. If that's not disclosed clearly, the client might be steered down a path based purely on the advisor's side deal.
And what about those really tangled situations where interests seem completely intertwined, like, say, advising a company, a corporate client, but also advising the CEO or a director of that same company individually?
Oof, yeah. That creates a very complex dual relationship conflict. Think about it. The best interest of the individual director, maybe their personal tax planning or investment goals, might directly clash with what's best for the company overall, perhaps during a restructuring or something. These situations demand extreme care, very strict internal barriers, often called Chinese walls, and almost always require immediate, clear, and detailed disclosure to both parties involved.
Okay, this brings us neatly to disclosure then, and its limits. If you simply can't avoid or fully mitigate a conflict, the FCA rule is clear. You must tell the client about it. The mandate is that any material conflicts, ones that could genuinely influence things that can't be eliminated, must be laid out for the client. And crucially, in clear, plain language before any advice is actually given.
That's right. So, for example, if your firm gets marketing support from a specific fund provider, maybe they help pay for advisor training events or give you subsidized software, and that support is relevant to the advice being discussed, that relationship generally needs to be disclosed upfront. It gives you, the client, transparency about potential influences operating behind the scenes. But, and this is the really critical point, maybe the aha moment disclosure by itself is not enough. It is absolutely not a substitute for fair conduct or an excuse for bad practice. Simply telling a client, hey, I have a conflict here, doesn't suddenly make unsuitable advice okay. The advice itself must still be suitable, must still prioritize the client's interests above everything else, including the firm's or advisor's gain. You can't just sell a poor product and then say, well, I told you I was conflicted. That doesn't wash.
That is such a vital distinction. It underlines that managing conflicts is fundamentally about the quality and integrity of the advice, not just about ticking boxes on disclosure forms.
Absolutely. And when you tie this whole management framework together, the systems, the registers, the controls, the disclosure, it all loops back to deeper principles of professional ethics. The FCA's own principles for businesses hammer this home. They require firms to act with integrity. Principle 6 is all about treating customers fairly. And Principle 8 specifically demands that firms manage conflicts of interest fairly, both between itself and its customers and between different customers. These aren't just abstract rules. They're the bedrock of earning and keeping client trust. And remember the SM&CR framework we mentioned, the personal accountability piece. Under SM&CR, certified advisors are held personally responsible through the conduct rules. You are explicitly required to act with integrity, and specifically, always act in the best interest of the customer. What that means in practice is simple. When the client's needs clash with your potential commission or your firm's revenue targets, you have to choose the client every single time. No exceptions.
So ultimately, managing conflicts of interest effectively really becomes the acid test of a firm's culture, doesn't it? It's about building a system, an environment where integrity isn't just a policy tucked away in a manual, but it's the default way of operating, making sure that the drive for short-term profit never, ever compromises that long-term relationship built on trust, impartiality, and genuine professionalism.
Which brings us to our final thought for you today, a question to maybe ponder. Given that these conflicts are, to some extent, inherent in any commercial relationship, how can we, collectively, regulators, firms, advisors, and informed clients use transparency and that personal accountability framework to really ensure that every financial decision made supposedly on your behalf genuinely reflects your best interests and your conscience, rather than even subtly reflecting your advisor's potential gain? It demands ongoing vigilance, a constant commitment to fairness, independence, and ethical conduct from everyone involved.